In the past year, we've seen significant increases in physical impacts, severe storms, extreme heat, drought, fires, and floods. Longer-term impacts are more top of mind as well, given the recent meeting of governments at the event known as COP26 in Glasgow, Scotland, and the scientific research and report leading up to that. We saw that right now where we are is at 1.1 degrees centigrade above pre-industrial times, and therefore the extreme weather we're seeing. If we were to, as a global, as a world, were to adhere to the Paris Accords, we would be, by the end of this century, at 1.5 degrees centigrade. And we're not even close to that. If things don't change, we're going to be far beyond that. So we're seeing a real understanding of the immediacy of the need for change. Stakeholders are accelerating their interest and pressure on the issues, whether it's employees, customers, regulators, investors, activist investors, as well as institutional investors. And the implications are huge on business models, technology investments, and strategy as companies navigate transition risk. As we've heard in a survey of board members and executives done by KPMG and the law firm Eversheds, two key reasons are emerging as the reason why companies are moving toward decarbonization. One, which was 43% of the companies that responded, is to protect company reputation. And 28% said it was really important because of pressure from key customers. We're hearing a third of the respondents say employees have expressed dissatisfaction with the company's climate change impact. And 40% of the companies responding actually had employees who left the company as a result of the company's climate impact. And 28% said job candidates are now asking about the company's climate impact before they decide whether to take a job with the company. So from a corporate director's perspective, the pressure to act more aggressively in climate change, in some sense is nothing new. After all, the largest institutional investors have been talking about it for a long time and really clamoring for greater disclosure around climate risk and companies' carbon footprint. But with the physical impacts rising and the window for preventative action narrowing, along with the White House putting climate risk front and center, boards are seeing the need to do even more. So, while a discussion about climate change often tends to go more to the issue of first disclosure and then risk, we're going to focus on the flip side as well, because it's important to remember that there will be tremendous opportunities for value creation over the coming years for those who are able to capitalize on them. So today we have a panel of true experts who are going to join us to discuss the key trends and what boards need to know to address them. So let's meet them now. First, Heidi Dubois, the Executive Vice President and Head of ESG at Edelman. Welcome, Heidi.
Thank you. It's great to be here.
Next is Marianne Hancock, the CEO of Y Analytics and a director on the board of TPG Pace Beneficial Corp. Hello, Marianne.
Hello, great to be here.
And Craig Jimenez, a director on the board of Air Tractor Inc. Hello, Craig. So let's get started by each of you taking a minute to introduce yourself. We'll start with you, Heidi, and then go to Marianne and finish with Craig.
Sure. Hello, everyone. Again, it's a privilege to be here with you today. I head up the ESG strategic advisory practice at Edelman. You may be familiar with Edelman as a global PR and communications firm. Our team also conducts ESG advisory work in addition to communications and ESG reporting. Prior to joining Edelman to lead this practice, I headed up the ESG functions at both BNY Mellon and before that PepsiCo. So great to be here, and I'll pass it on to the next person to introduce themselves.
Thanks, Heidi. And it's great to be with everyone listening, and of course with Susan and Craig and Heidi. My name is Marianne Hancock, and I lead an organization called Y Analytics, which is the impact assessment arm and the ESG arm for TPG, the private equity firm. And so we are in the midst of all of the ESG work that's done in and around private equity, and from the investor perspective, as well as the creation, more hopefully, Susan, to your point, of products that actually involve investment in climate solutions as well. It's great to be here. Craig?
Hi, I'm Craig Jimenez. I've been active in mitigating emissions and trading the associated credits since about 2001. Typical examples would be cap and trade markets in North America for sulfur oxides or acid rain, renewable portfolio standards for power generation, and the greenhouse gas markets, both voluntary and mandatory. 2014, I co-founded a failed carbon capture firm. We worked 4 years for free, but it was time really well spent. It was fascinating. I currently serve on the boards of Air Tractor and NACD North Texas, and I'm a board observer on a green hydrogen company. Got a current interest in sustainable aviation fuels and other ways to decarbonize the really hard to abate sectors, and I'd look for feedback from the audience in general to help me come up that curve.
So, and speaking of, thank you, Craig. And speaking of feedback, so please put comments in chat, put questions in the Q&A, and we'll try to get to them as we can. So Marianne, I'm going to start with you because the financial implications clearly are huge. So how are you seeing ESG factors in general, but focusing on climate issues specifically, influencing valuations and targets?
Well, there are an enormous number of ways and dimensions, I think, that this financial case is playing out and will continue to play out. But I think we start at the highest picture level from saying this is a full reengineering of our economy. If we're going to actually live into what you were describing, Susan, we need to live into, this is a complete reengineering of all that we do, the business models, the supply chains, engineering, et cetera. And so starting from that, it reminds us in many ways of the digital revolution, in terms of its scope, in terms of the fact that every board and every company and every strategy, will wake up and needs a climate strategy, just like you needed a digital strategy. But the thing that we're seeing that's really different here is that the kind of capital that's needed is different. This is a very physical transformation, right? So when we had the digital revolution, you could create something in venture, you could get the great idea out there on the rails of the internet, and that was basically free once you created it. So a lot more came directly from venture into the rest of the markets. Here we have to actually physically re-engineer the economy and the ways that we are working, the ways we're producing goods and services, the ways we're consuming or not. So there's a big shift, I think, in the kind of capital that is needed, a lot more about scaling capital. And we see in terms of what's investable, really a trend that has been key is some of the forces that you just described. It's consumers, it's investors, it's entrepreneurs. And one of the most interesting breakthroughs is that the technology curves have actually started to allow for business models to work. Of course, some of that comes still through, in some cases, government incentives and the current administration's support there. But more and more, we're seeing that it has nothing to do with incentives, or those are a much smaller piece of the puzzle. And that can be from things that we all know and hear about all the time, like solar, wind, and EVs. But we track about 85 different subsectors, and that's just probably the tip of the iceberg that has everything to do with from e-bikes to alternative proteins to low global warming potential refrigerants to glass for buildings. I mean, there's just an enormous number of subsectors out there that are becoming or are investable today. So from an investment perspective, there's a lot of transformation that needs to happen. The capital is about scaling capital, and there are a number of investable universes right now. Obviously, there's a whole other piece of this for many in the audience who are looking at companies that they're on the boards for now who may not have those kinds of opportunities. And the financial implications there are also huge. We'll probably talk more about that as we go, both on the opportunity side, but then also on the risk side. So I'll just pause there, but I'm sure there's a lot we can get into.
Okay, and we'll come back to a lot of that. But first, I want to turn to you, Heidi. So obviously, Edelman is synonymous with the concept of trust and understanding what builds trust in companies. So, you know, you've got some really interesting trust barometers, which frankly I had not been aware of until we had our planning call. So now I'm hoping that others have, but they're wonderful. There's a specific one on climate and a specific one on institutional investors. You know, talk generally about what you're seeing from a kind of company reputation angle, and also specifically about some of the themes that have come out in these two barometers.
Yeah, sure. So just to give the audience a little context, Edelman is known for its research on trust, which we do define scientifically and measure scientifically. So leading into COP, we thought it would make sense to conduct trust research on climate. And we surveyed 14,000 individuals globally across a number of dimensions specific to climate. In addition, in mid-November of this year, we released our 5th annual Investor Trust Barometer, which focuses on those factors that impact investor trust positively or negatively in portfolio companies and or prospective investments. So from the climate angle, we're looking at who, for example, who is a most trusted source on climate change. Scientists came in first, with 76% of those surveyed trusting science to tell the truth about climate and what the country should be doing. Sadly, CEOs came in last. They are the least trusted partner on climate, with only 42% trusting CEOs to be transparent and reliable on the same topic. On the investor front, the expectations are clear and they are growing. So most investors, a substantial majority, expect companies who have not yet done so to create and disclose a plan for achieving net zero emissions. In addition, the expectation for boards to oversee not only climate and environmental issues, but ESG issues across the board is almost universal. So I didn't intend a pun there, but yes, the bar is high. And you know, in addition, investors have pretty healthy skepticism about the ability of companies to actually achieve targets like net zero. So clearly work to be done on enhancing investor trust in this area.
Thanks. And I've seen questions already starting to come in, so we'll get to them shortly. But first, Craig, you know, so speaking of the interest in board oversight, you know, just sort of what is happening in boardrooms in terms of, you know, the approach to climate issues, you know, what kind of leadership is really needed in this environment, and then talk a little bit about capital allocation, which I know is an enormous issue too. As Marianne's point, this is nuts and bolts. This is not stuff that is, you know, sort of programming and then once and done. So, you know, from your perspective, or, you know, just generally what you're seeing in boardrooms, would you talk a little bit about that?
Sure. I think the biggest change in the boardroom approach to climate has been this very welcome shift from single forecasts, you know, single outcome. There's a line from here to there, and we'll be on that path, to much more robust set of scenarios, all of which are treated as plausible, and we can argue in the boardroom, and we have a reasonable difference oftentimes on the probability, but they're all considered plausible. They're all considered in their nuance, like what would we do, capex, operations, etc., to thrive in that environment, and that creates a little bit more resiliency in the company's ability to change. And we also, the good companies will provide some markers to say these outlined scenarios are becoming more probable if we see the following things in markets and Edelman and other indications of social or regulatory change. Leadership, we really do need much more bold leaders than we have heretofore had. We've always wanted leaders who do the right thing when nobody's looking, and climate's kind of weird because everybody's looking, but very few people are really equipped to call bull on a CEO when he proclaims a commitment without a plan. We're just not there yet. But we are looking for leadership that actually does have a plan before the proclamation, that has a near-term plan, an investment in mitigating emissions starting now, and a sense of honesty about how much it really costs to permanently remove carbon from the atmosphere. It is not $3 to $5 in the voluntary market to plant a tree. It is hundreds of dollars currently, and hopefully getting down to $100 a ton. That is a much bigger thing, and we can't all go out and buy the same Kyoto era CDM credits, most of which are questionable in their impact anyway. So, when every corporation's plan is to buy the same limited set of discredited credits, we may have a problem, and that's why people don't trust CEOs yet. I give a shout out to Scott Kirby at United Airlines. Says, we're signing large offtake agreements for sustainable aviation fuel now, 7 million gallons a year. It's a small part of the current thing, but it's about a 10 times the current market, so that we can finance and get facilities started and built. So leadership, it will be the key thing. In terms of capital allocation, I can just give you one example. Our green hydrogen company is pretty early stage. And we have strategic investors at so much earlier stage than I have ever seen in any hard tech environment ever. It's shocking, but they came in a very nimble and low hassle fashion as venture investors. Very small investments. Obviously, we're not waiting for the parent company's board to make a decision on any of this. They were just basically authorized to make small investments in this space, and they did. They made a lot of them. And now they're looking for those companies that are making some progress. They're transitioning in their parent company people who have direct access to the facilities to assist us in siting hardware. And that is also phenomenal, because in the old days, you used to have to kind of guess where your customers might want to put things, and you conducted these grad student exercises. Now we have people telling us, no, put it in this facility in Lyon because the plant manager is really into it. And she will help you finish this. So it's incredibly encouraging in terms of CapEx from strategic investment into little companies. I'm not sure how it's going elsewhere in the economy.
Now, just you mentioned green hydrogen, and just for our audience, would you just explain, just at a high level, sort of what that is and why it's important?
Okay, hydrogen is used as a feedstock in a number of industries: petroleum refining, ammonia production for fertilizers, and it also has potential as a fuel for long haul transportation and energy storage and so on, with a lot of caveats, frankly. But there's currently a very large market for just hydrogen as a chemical on an industrial site. And there are a number of ways to produce it, one of which is steam methane reformation, which is you're taking that gas, you're stripping off the carbon, and you're emitting carbon into the atmosphere. This is not a very good way to get hydrogen. It is very carbon intensive. There are other ways. There's electrolysis from water, which is a pretty common way. It's a mature technology, and Advanced Ionics, the company I work with, is pursuing that path with a nuance to reduce the amount of electricity needed by using some waste process heat. would be kind of the niche they're pursuing. There are other ways. You could reform methane and sequester the carbon, but nobody's actually doing that. You can do pyrolysis. There are a variety of ways to get hydrogen, but the most promising, we think, given the continuing drop in the price of renewable electricity, may be electrolysis. And we're going down that road at the moment.
Thanks.
Susan?
So,
Could I
yeah.
just to pile on to one of Craig's points there about the really interesting ways that we're seeing larger corporations partner. One is in exactly as Craig was saying, where there's taking investments in positions that never would have necessarily been taken before. It's just not the normal way for use of balance sheet funds, but it's really proving creative. But then partnering to actually get that scaling piece right. And that's really quite instrumental in this growth of these climate solutions companies. The flip side is also true, is that there's plenty of companies, large corporations, who have invested in projects within their company somewhere. And the creation now of a spotlight to capitalize those either outside or quasi outside of the parent corporation is another path as well, because it can lead to different access to capital, different cost of capital, and different talent pools. So just wanted to highlight that, as that might be something that that members in this group see.
So I want to turn to the question that came up, which is after COP26, it was said that bankers and companies were, really limiting the progress needed. So the question is, how can we incentivize the financial markets to do the right thing?
I'm happy to start and others can pile
Sure.
on. I actually was a little bit surprised by the question. It probably depends on the perspective you're taking on who is meant by companies. So let's put aside perhaps for a second the oil and gas companies. But if we think about the financial institutions who probably were minimally part of the conversation in the last COP, they actually came to the table quite strongly. Now, with the $130 trillion commitment towards net zero. Now, living into that is going to be the big question that I think Heidi so rightly pointed out.
Yeah.
But they did come, and they came in a way that even maybe 2 or 3 years ago, I don't think they would have. Certainly 5 or more. So so there's at least hope in that regard. And living into those commitments now, I think, is the hard part. But it is different.
I think it's different too. When I started out many moons ago, a lot of these commitments, and I know people have talked about this quite a bit, where, came out and then there was no execution plan. This is CapEx in many instances, as others have already said. I'm seeing more companies realizing they've got to do a feasibility study and then capital allocation in order to meet what they say they're going to do. And that may sound obvious, but it hasn't been in this field. So I think that is just simply, if you did a natural language search on use of the terms CapEx and feasibility in the conversations, at least that I have with issuers, it's definitely gone up. The other thing that I would say about, getting companies to do quote unquote the right thing, I mean, behind any asset manager sits asset owners, and preferences of asset owners are changing. And the asset managers are fiduciaries of the asset owners. So they must execute the preferences of the asset owner as reflected in the investment management agreement. And that's where I think you're seeing movement as well.
Yeah, that's helpful. So I want to go just to, sort of the whole panoply of risks. I mean, we talked about physical risks, reputational risks, there's regulatory issues, there has been litigation, there probably will be more litigation, and my prediction is that a lot of that litigation will be on the issues that you've talked about, Heidi, and all have talked about, where there's a statement made with nothing to back it up. The whole concept of greenwashing, this concept of transition risk. you're in an industry or you're just a company that is trying to find its way in a world where decarbonization is important. But yet at the same time, yes, you're going to invest in it, but you also do have some who are going to say, well, yeah, but what was your last quarter like? And that still is, sort of part of the reality. Um, Marianne, as you're looking and assessing companies, how do you think about, sort of how are you looking at the company's risk profiles as it relates to climate?
Sure. So we tend to find a helpful anchor in the sustainable accounting standards board, the SASB factors. Not because they're the only ones out there. There are hundreds out there that you could look to, but we do like the fact that there's a sector focus there and a sense of what's material. So if we're looking at an education technology company, they're less likely to worry about physical climate risk than or transition risk than an industrial company, right? So just as a starting point, we tend to look across. We tend to look in a sector by sector basis. Then there's a much deeper dive to say, great, across the footprint, both on the product side, risk and opportunity, and the supply chain side, risk and opportunity. What are we seeing on the climate front? That's inclusive of GHG footprint, but it's also inclusive of water usage, in particular, for depending on the geography in which the companies are operating, waste treatment and reduction over time. And again, that really varies substantially by sector. The one thing I would just say, and you mentioned this, but I do think that physical climate risk is rapidly becoming more attuned, and the tools are finally coming along to help companies assess that in a more methodical way. But we are living it in advance of the tools necessarily having been there over the past several years. So there was disruptions to supply chains, heat situations for employees, the effects of storms, right? We are living those things already and they will continue to get worse. And so I just want to make sure that that continues to be part of the assessment. And we do have that as one of our factors. The one last thing, so the surprising thing to some folks is in that supply chain, digging in and making sure you understand not just if you're producing something that might be affected by carbon tax or other type of situation like that, but if you're reliant on a material that is likely to be core to the next EV situation, those prices are going up, just as an example. So it is a bit of a systems issue to look at that transition risk.
So in other words, to understand what your raw materials are being used for and whether there might be a supply issue because of their usage in something else. Yeah, I think it's a great point.
We've been using the term enflation, E-enflation, for this, the cost of materials, but also the potential for regulation to move faster than technology and available resources, which goes right to speed and smoothness of an energy transition.
So many people on boards are not climate experts. Outside of the industries that are most directly affected, it frankly would be unusual to have a climate expert on the board. But yet, as we've said, all board members need to really understand it. A good friend of mine who's an expert in climate a couple of years ago referred to climate as the next cyber. And I always think of that. And it's the same concept. This is something that is affecting every company, but yet it is in an area where a lot of board members are not specifically, sort of expert in the topics. So I know, on our planning call, we talked about, sort of some of the questions that boards can be asking. And I think Wendy may be either putting them in the chat room or kind of sending some along. But Craig, I really want to come back to you on this for, what's your message for board members who may or may not be climate experts, but knowing how important this is? What are some of the questions you would be asking? What's some of your advice in terms of how boards should be getting their arms around these issues?
Well, I would, point to the resource list that I believe Wendy will probably post in the chat or somewhere else. It's a series of links that you've provided, Susan, that I found to be very accessible for non-specialists. They're pretty easy reads, a few minutes each for the most part. Even the kind of founding documents like the TCFD 2017 document, it's remarkably easy to read, at least the intro and the couple of sections that may apply most to you. There's no reason that lack of, sort of science background should inhibit any board member from exploring this area. I think it's one that really just hasn't been talked about very much. I think we need to just tone down the ideological nature that is kind of rampant in our society and many, and just kind of talk about, hey, if these scenarios come to pass, and these regulations come to pass, how do we adjust our company? And that kind of starts a conversation. There is merit in many instances if you're a very large energy producer or energy consumer, or you use materials which have a significant greenhouse impact, like fertilizer or cement or other steel. There is merit in bringing in one or two people who have a little bit more experience, either as a consultant or as a board member, as long as they have the general business savvy to contribute to the other aspects that we would expect from a board member. But there's plenty of good material out there, and I think, Susan, your list, and feel free, anybody, to reach out and say, hey, what would be a good resource on this topic that's bugging me? I think the four of us all have seen a lot of stuff and have found things that are more helpful than others, and we'd be happy to guide you.
Yeah, it's perfect. And just to decode TCFD reference, it's something started by Bloomberg. It's the Task Force on Climate Financial Disclosure, which I agree. It's a tremendous resource. It kind of helps look through, sort of what are the strategic issues, what are the risks, and gives sort of a framework. Although it's about disclosure, it's also really about the framework for understanding the risks and the strategy. So I would agree completely. And there are, obviously there are other frameworks as well, but some of the questions, kind of what's the exposure for the company, and really understand it. What are the company's strategies? How does the company getting its arms around the stakeholder expectations? And, how is the board discussing it? I want to shift in the time that we have left to a different question that's particularly relevant to an LCDA discussion, which is the impact of climate issues on communities of color. So, the research on the intersection of racial wealth inequality and climate change continues to emerge. But we do know people of color and low-income households are hit hardest by the physical impacts of climate change, and also by the economic impacts of transition changes, to the extent that they're not part of the newest buzzword, which is a just transition. So a transition that's equitable as well as changing. So, whether it's because people live in neighborhoods with higher exposure to extreme weather and less built-in resistance, overrepresentation in impacted industries such as agriculture or other industries, the issues are real. Heidi, you had turned a phrase which I thought was so important, that climate change is seen as a white, wealthy, and Western issue. So I just want to, throw it open to whoever wants to chime in on, how should companies be thinking about these issues? How should it impact the trade-offs? And then also, how can LCDA members use voices in the boardroom to address the issues? Who wants to start?
It's a hard one.
And then we'll solve world peace once we finish this one.
Oh, yeah, we've done that.
Yeah, right.
No, I think in some respects, pandemic brought forth intersectionality of issues. So those who are disproportionately impacted by climate change are those who tend to have less advantageous places to live, with more difficulty accessing vital services in times of natural disaster, and that can include health services. If anything, I think companies have to explore what the trade-offs are and be open about the decisions they make. As a global community, I hope that we can come to terms with an equitable energy transition that, maybe it won't get us there as quickly, but perhaps with less human cost. And that's a balance too. A rapid disruptive transition could result in political, social, and other forms of unrest that are equally undesirable. I think also with various technologies, as Marianne was describing, there might be environmentally questionable or socially questionable things behind them, like sourcing a material from a particular region of the world where human rights risk is significant. So just exploring it, knowing it, and making decisions with knowledge and being open about those decisions. I hope that's the path that most people will take.
I would chime in with that. Heidi, you said it so eloquently. It's complicated. It's really complicated, and it's not going to be easy on many fronts to navigate this. There's no easy button on this one. That said, that what you pointed to, I think, is one of the best antidotes to the potential continuation of negative effects or inadvertent negative effects, which is as much learning as possible. I don't think I've learned more in my career than I have in the past several years. It is an invigorating place to be and space to be, but we all need to get comfortable that we have a lot to learn in this. And one of the ways to do that at the micro level, as opposed to at the macro level across countries, but at the micro level, is to say, this sounds like a really good answer or a really good solution or a really good product to invest in or a product to buy at home. What's behind it? And it's not because we're going to therefore declare something going from good to bad, but we're to declare something, okay, that actually has some negative repercussions in its supply chain. We're going to figure out how we can improve that situation. Or we're going to look for something that doesn't have the knock-on repercussions to the negative. And that's just an exercise we all just have to get used to doing, and questioning every time something says green. I did see a study recently that said that it was a psychological study. It wasn't an actual empirical study, but it was a psychological study that was saying that when someone was shown a picture of nature, they were more likely to dedicate their money, no matter what, right? No matter what information they had. There's a little bit of good in that, but a whole lot of concern in that too. So I think what you said, Heidi, is exactly right in the way we need to pursue this. We need a just transition there.
I would offer an opportunistic thought. When I look around in clean tech in particular, it is overwhelmingly white and male. And the perspectives of people who live in flood-prone areas are not considered at all, because there just aren't any people and they don't know any people. This is a tremendous opportunity for LCDA members to get involved in this area. It's going to be a generational area of expertise that we all need. If you start to excel in this, you will also stand out as one of the few non-white males in the field. So
Craig,
please, please go
I
ahead.
gotta support you there too, because I think another evolution that we're seeing in perception and thinking is climate has been, a natural capital issue or science issue. It's a people issue.
Yes.
It's human. I mean, Marianne just said if you look at nature, you feel something. And, we have to win hearts and minds. And, those members of this organization have had quite a lot of experience in bringing people um, to the fore who belong there. Right, and that's part of the battle towards a more climate just society as well.
I couldn't agree more. And in fact, I was on a call earlier today where there were a lot of investors, institutional investors, pension funds, and there was a lot of passion from that group around this issue of, for companies that are green, what about the S in ESG? And looking at the social issues, so it's not good enough to just be green, that all of these issues are incredibly important. So we are running out of time, and I just want to give each one of you a final opportunity for a final word. And I'm going to go Marianne, Craig, and then Heidi.
I would just echo what I said a second ago on Heidi's note, which is this is the most invigorating time. Keep learning, read all that we can, keep sharing.
I'd say for board members, our actions on climate have both competitive aspects. We want to position our companies to not just survive but thrive, but also a collective responsibility to mitigate our emissions. Because even if you're a cold bastard, if your customers can't buy your stuff because they're swimming, you did not win. So we have both, an opportunity and a responsibility.
Yeah, I have a lot of ideas, but I'm going to be bold. The role of the head of ESG in corporations has changed quite a lot, migrating from communications and marketing now more towards strategies, to some extent finance. Some companies have a futurist on the team, and I hope that's the next iteration of this role.
Love it, love it. And I'm just going to conclude with use the power of the boardroom. Clearly this is the most important issue of our time. I cannot tell you how many board members have said to me, I fully understand the importance of this issue, and I wish I could get my board, really more engaged in it. So if we do nothing else as LCDA members, but engage every board on this topic, the accomplishment will be huge. So on that note, thank you all. This has been a wonderful discussion.